All right, good afternoon, everyone. It is a real treat to be back here this is the fourth conference that I've joined for, and it's really exciting to be here and to come back because every year I see how the room grows and how the community has grown, and that's a really big thing that I look for as an early stage investor. It's pretty formulaic in terms of what we look for in startups. They're just things that make for a great investment deal, and that's what I'm going to talk to you all a little bit about today. Trying to debunk effectively what are investors looking for across industries when we are seeking to make an affirmative decision on whether or not to invest. But one of the really important core things that we certainly can't provide ourselves, we provide capital, we provide connections, but the thing that all entrepreneurs need, not just founders, but entrepreneurs need to be successful is a strong and supportive community. And that's one of the most important and encouraging things I've seen every time I've come to Medellin. And it's really exciting to see how entrepreneurs have matriculated into the Techstars program that I look after. And that's the thing that's always top of mind. So above and beyond the programming and support that we offer, what does the ecosystem of support look like? And exactly how will our investment fare? So this is something really important to consider. And for everyone sitting here, you may not all be entrepreneurs, but I assure you that you all have a very important role to play in the entrepreneurial ecosystem. From the insights, from the feedback, from being customers of businesses, from showing up to events like these, they are all such important and powerful roles that you play. So I hope that as you reflect on today's comments, you feel a sense of pride of knowing just how much you're contributing to this incredible growing startup ecosystem that I'm excited to visit every year. And my goal is that next year I might be able to do maybe a part of the presentation in Spanish. So first, before we talk about what investors are looking for when they make an investment in an early stage startup, I thought it would be really helpful to ground ourselves in what is entrepreneurship. And it's something that we sort of gloss over when we think about going out to engage with investors, but it's really important because very often our first vision of what it means to be an entrepreneur shapes the way that we think about the market opportunity. And so I've always personally thought it was really interesting for every investor that I've met is to ask them, what was your first view into entrepreneurship and what that meant? And how does that shape the way in which you approach investing and working with founders today? So for me, my first vision of an entrepreneur, what it meant to be an entrepreneur, was actually watching my grandfather operate a very successful business. And so there are a few things that I learned from seeing him sort of operate this agricultural enterprise. They were effectively shipping cocoa to chocolatiers so that way everyone could have wonderful confections to enjoy. And there were a few things that stood out to me and a few things that stuck with me as I venture into the market and say, what does it mean to be a truly great entrepreneur? So the first thing is to have a great product that you really believe in and that you stand behind. That's really easy when you're helping the world sort of consume sweets. But for any entrepreneur that I've met, that is one of the things that I look for and that stands out and is so exciting to me. They fundamentally have a vision of what does a better world look like? They are committed to this specific problem that they're solving. And we've seen that in all of the incredible pitches. Your pitch was awesome. Really loved it. The second thing is operating a business that is mindful of the community in which it exists, and also operating a business in a way that represents the personal integrity of the founder. So these are things that I look for in founders that I invest in. And that I see that in the way that they build and scale their businesses. Can you imagine an entrepreneur that says, one of my primary commitments that I'm going to make is I want to work with founders who, for them, integrity is sort of in that top 3 list of things that I know they think of as they're making every business decision. And it gives you a good sense of confidence about how they are going to steward the company forward. And then the last piece is community. So one of the things that I saw my grandfather do time and time again as he grew the business was he reinvested in his community, building critical infrastructure and trying to create more opportunities for education and entrepreneurship. And if you had looked at this at a high level, it might have seemed philanthropic in nature. And it took me a little while to realize actually the genius behind that, because effectively what he was doing was saying, I want to create an ecosystem. I want to create a network. There's so much more prosperity and fruit for us to all enjoy if we can help everyone tap into their productive abilities. And so that's the other thing that I look for as I engage with founders, not only what is your vision of how you're solving this problem, but what's really the impact that you want to make on the world, because we have to remember that it's easy to get caught up in the flashy and sexy novel technologies that we see, but ultimately companies are groups of people, and how you treat people and those dynamics between people and the culture that we set with which they carry out into the world as they engage with other employees and other customers, that makes for a truly successful enterprise. So when we think about that lens of where are entrepreneurs found and what does an entrepreneur look like, for me, I had a very atypical profile, and so that means that I know that entrepreneurs can be found anywhere in the world, because talent is evenly distributed, even if opportunity is not. And so that is my goal, and that is my role as an investor, is to go out into the world and say, where do the best opportunities exist, and how can we help bring them to market? All right, I'm going to move this way and see if it works. Oh, no. I might not be pressing the right button. Okay, there we go. And so that brought me to my journey today. So carrying a lot of those principles around what great entrepreneurship means, what it means to operate and steward a business, that served me well as a startup operator. So I've worked with 9 companies along the various alphabet of startup funding, exited 8 of them, stayed with 1 through IPO. And what I saw along that journey was a lot of the places that startups sort of get tripped up in their path to growth and how to overcome that. I think that's the only relevant thing I see when I look at sort of this list. I'm like, I failed a ton and I figured it out, and hopefully those learnings are helpful. And the other thing is really understanding that journey. So there's the journey of the business that you're building, and then there's the journey of how you achieve that financing. And sometimes those things align, and sometimes they're very different. And so what you might be surprised to hear as we go through the course of this presentation is I'll certainly talk about how you can put yourself in the mindset of an early stage investor if you're going out and pitching VCs and saying, I'd like to secure some funding. But ultimately, I hope you'll take away a little bit of wisdom around what it means to build a truly enduring business. Because I always tell founders the best strategy that you can employ for growth is one where you have maximum sort of options and opportunities at your disposal, because markets are fickle and we have to be able to plan for various scenarios. And then what's venture capital? So we know what an entrepreneur looks like. We know what we think really great principled entrepreneurship looks like. And sort of venture capital can seem to be a little bit of a black box. And so there's a lot of text on this screen, and you can take a screenshot if you want. But the one thing I'll call your attention to is just that sort of unicorn in the corner. That's really what's it about. What does it take to be a venture capitalist, at least in the US? You require no formal training, no education to actually do the thing. You just have to be accredited. It means you have to have money. And so beyond that, what are you looking for? Well, you now have the responsibility of managing other people's money. And so you might think, okay, well, this means I have to go out in the world and find great businesses to invest in. And that's only partly true, because not all great businesses make for great venture deals. And I think that this is something that founders continually lose track of as they're caught up in the excitement of what they're building. You have to ask yourself not only about the value you're creating in the business, but also, is this ultimately going to be a good deal? And so what does a great deal look like for a VC? At a high level, ultimately, what are they looking for? Well, if we think about the fact that the typical sort of life cycle of a venture firm is around 10 years, maybe 12 to 13 years, we're seeing more recently, this means that they are looking for near-term opportunities, so startups that are going to invest in, that at some point in that 10 to 12-year journey is going to exit. They're going to have a liquidity event such that they can return more money than they were responsible for managing back to their limited partners. And that's the track record of success that they depend upon to be able to raise subsequent funds, deploy more capital, to invest in and support incredible founders like all of you. And so materially, what does that mean? So we know It's very common. Everyone wants to build a unicorn company or invest in a unicorn company. What does that mean? So first, it's around that $1 billion valuation. We think this looks a little something like when you IPO and the overall sort of value at that stock, but we're also looking at it from a sales and go-to-market momentum perspective. So we're also asking ourselves, within 5 to 10 years, do I think that this startup can generate $100 million in ARR? Because based on current market multiples, if they have an exit, that might be an IPO, might be an acquisition. Maybe we'll have an opportunity to exit our position a little early, doing something called selling our shares on the secondary market. Is that ultimately going to provide you with enough capital to return the investment that you've made? And so typically, if I'm looking at an overall portfolio, so let's say my Techstars portfolio is probably 85 companies today. Just based on the law of averages, we look at that and we say maybe five to six of those are going to have some truly incredible exits. More than 70% will probably return nothing. And for the others, we're looking at some early stage exits, acquisitions that might return between 2 and 4x on our investment. And that's another important thing to keep in mind as you're thinking about how you approach investors, is being mindful of their overall portfolio and where you might fall within that and how you can best position yourself and tell the story not only of, I've got a great product, I understand my customer, there's a great market, but also there's enough size and runway in the market for me to be a really great fit to join the portfolio. What am I pointing at? That thing? Okay. I don't think that's it. I have to be at the podium and point? Okay, there we go. Okay. And so generally, once you embark on that journey of fundraising, there's sort of 5 overall stages of funding. There's a lot of stuff that happens in sort of in the interim. There's lots of bridge rounds and things like that. But generally, I think this is a very helpful illustration because based on where you are in that journey, the message that you're taking to market to your investors is going to change a little bit. So I typically deal in the sort of pre-seed and seed part of the market. So this is at the earliest stages of building your business. There's probably very little traction. There's very little revenue. Maybe the product exists in its sort of beta iteration. And so what that means at the earliest stages is what we're really betting on is team. And so if you're a founder at the earliest stages in your fundraising, what are some of the questions that the investor is asking themselves about your ability to build a $1 billion business? Yes, your product and technology in part is important, but also, can you recruit a world-class team who is going to build this thing with you? This is why we say team, we over-index on team at the earliest stages. It's sort of team, team, and team again, because everything else is more or less a little bit of a hypothesis. But what we have is our lived experiences, our understanding of the person sitting across from us, and we're trying to do that mental calculus of saying, can they go the distance? And that's where we get into some of the conflict around, and I think a lot of the dialogue around investors investing in people and communities and groups that they know, but that's part of the calculus that we're doing. What are the different data points? What are the clues? What are the things that you've done in your past that are laddering up to help me understand and satisfy, because I have a fiduciary responsibility to make sure I'm making the highest and best sort of use of those investment dollars. But what are those different things that I'm seeing on display that tell me this founder can go the distance? And by the way, very often that first product idea or iteration, the first iteration of what that customer looks like, that's going to evolve over time. So we're looking at your idea at the earliest stages when we're saying that's interesting, and that might be what it looks like 5 to 7 years from now, but maybe not. So I better make sure that this is a team that I'm crazy about and that I love and that I want to bet on, regardless of where they might pivot and what they might build. And so embarking on this journey of raising funding from VC is not one to be taken lightly. So one last thing I'll add before we go through in detail specifically what I'm looking for in early stage investments are the key considerations of what does it mean for your business to accept outside capital. And this is really important because it's hard to figure this out after the fact. You can't say, never mind, I changed my mind, I want to give the money back, I want to undo it. That doesn't happen. So fundamentally, when you accept outside capital, this is no longer your baby, your brainchild, your project. This is a business of which you have multiple stakeholders. There is going to be accountability. Your vote on what you think is right is not going to be the only voice in the room. And ultimately, you've accepted that there is going to be an exit or a liquidity event because you've accepted investment. And that's the premise of investment, right? We want to sort of buy into great companies and sell them at a profit. So first, really making sure that your business is poised for scale and growth. The scale and growth piece, that comes into where we're talking about in 5 to 10 years, do I think you can do $100 million in ARR? Fundamentally, if the business model is not one that scales, and I'll give you some examples at the end of truly great businesses, that might not be a great fit for venture, and that's fine. The second is investor expectations. So it's not just around the size of the check that you're accepting, but there's a lot of provisions and expectations that come along with that, and understanding what that means for you and the business that you're building. There's the financial transparency. At dinner last night, one of the guests had mentioned that the art of looking at the different sort of financial statements from your business, and that really being a place that's so important for all founders to start and be able to master, because there's a different expectation around the governance of your company and the financial transparency and reporting that you're going to have to do, because now remember, you are also a steward of other people's money. That also gets into governance and control. You'll likely have a board that's also going to have an input on big strategic shifts that you might make. And then finally, thinking about what this means for the new stakeholders you're going to have to manage post-investment. And so if you are sort of the crazy inventor that says, I do my best work by myself, I don't like input from others, this is an important thing to consider as you're saying, well, is this a hobby? Is this a business that I'm building? And if it's a business, how should I think about funding it and growing it? And so let's say that you have decided that you're going to embark on this journey to try to sort of secure institutional capital. You're going to go out and you're going to raise venture capital. Well, that's a great place to be because it represents more than just a check. So first off, VCs, we think of ourselves as sort of being the mothership for innovation. We see an incredible volume of ideas, and we take some crazy swings at that. What we're effectively betting on is what do we think the future is going to look like? And how can we materially participate in that? How can we make it better? They're also going to help accelerate your growth. So when you sort of receive investment, it's more than just the investment that comes along with that. It's also the access to network that you'll get through that respective investor. So that's also a really important thing to make sure you're doing your diligence on. And then also sort of job creation and impact. These are really important things that VCs add back into the ecosystem. I think we've all heard the stories of you may have a first-time founder, and maybe that first idea isn't necessarily the one that hits it big, but I think entrepreneurship, and especially in the startup world, it's like learning to ride a bicycle. You're gonna fall off a few times, you're gonna get a few things wrong before you finally sort of catch that wind. And you're off to the sales. And so that's the other thing. You're effectively joining a network that you may get a few additional chances at that. And by the way, this is one of the reasons that I'm so excited to come back here year after year to talk to all of you. Because when I look at Medellin's sort of startup ecosystem and what this incredible team is building, I see in spades all of these different things. There are incredible startups that we've heard pitch. There are some incredible startups here that we haven't heard pitch. Incredible entrepreneurial support organizations, universities like the one that we are in today, research organizations, all those things that help contribute to the advancement of the technology that we ultimately want to give commercial application to. Service providers, big companies, we had some incredible leaders of big companies this morning on a panel. Funding organizations, and all of those things sort of percolate together to create what I like to think of as sort of this vacuum for entrepreneurship, where ideas and people can start to really bounce off of each other. And that's where we get into some really exciting percolation. And let's suppose that maybe venture isn't the right path for you or not the right path at this moment. One of the things that's personally most important to me when I think about what makes for a successful founder is really the financial literacy around how you should be funding your organization. And so there's certainly a use for venture, and if you can secure it, great. But I also know that most investors don't want you using venture dollars and equity for necessarily every expense that you'll have. And so as you think about your business growing and the maturity and the complexity of your operations growing, you'll also want to think about the nuance around the different types of funding that might be right for you. And so we spend a lot of time typically talking about VC, but I always think this is a really important place to sort of center, because I see founders typically are focusing on like one of these 15 boxes and overlooking the others. And I will tell you the founder's journey is long and arduous, and some of the best founders get scrappy and make sure they uncover every source of funding that might be aligned with what they are building and pursue it. And specifically, when we think about growing the startup community here in Colombia, one of the most interesting facts is that when we look at startup creation and innovation, Colombia is consistently ranked within the top 3 in Latin America for being a hub for innovation and for growth. And so this specifically is a really great opportunity for VC, because there are lots of great ideas and startups that we look at it and we say, not only does this have a global TAM, not only is there a significant opportunity for scale, but we also think that we're going to be able to provide unparalleled returns back to the shareholders who also see value in what we're investing in. So I expect that the room and the community gets bigger and grows, and it does every year. And it's exciting to see how that's taking hold and to be a part of it. Okay. And so with all of that preface, what we're really going to get into now that I've made all of these sort of important considerations around how you should think about funding, what is it that an early stage investor is really looking for? And this is what I always share. It's a copy of the live investment memo that we've used at Techstars. I always share this instead of the pitch deck because pitch decks are beautiful. They're typically very formulaic. They're about 12 to 15 slides that follow the same outline. And there's this expectation about the sheen and the professionalism of the presentation with which we're going to receive. But the reality is that our job is to peel back all of that great sort of glitz and glamour and ultimately find those essential pieces that we're going to memorialize in an investment memo. Because remember, we need to be able to explain the logic of why we believe in this company. We have that responsibility to others. What are the key sort of facets that we're betting on? What are the key areas of concern? So we can all be aligned, because once we invest, we're all sitting on the same side of the table. So it's our responsibility to say, what were the perceived weaknesses, and now how do we help shore these up for the business? And so I encourage you all, there's tons of different templates out there for investment memos. You can take a copy of this one, but it's always a helpful exercise to go through your pitch deck or just think about for your own business and how you might fill this out. And this should help illuminate to you as you're going into investor conversations, what is it that they want to see? What are questions that they're going to ask me? Because the output of this process is that we're hoping to reach conviction. And conviction sometimes means we're convicted, yes, this is absolutely a winner we want to invest in, and sometimes it means we're convicted, no. Either way, we want to make sure that we've run a full process to say we really understood the thing, because that is our responsibility. I would say a suboptimal outcome is when we move through a process with a founder and we're just saying, we don't have enough information to get there. I've got to say that's probably the worst feeling for us as an investment team and probably for a founder. If you're saying, what you've done is great, but there's just not enough there. We can't reach conviction one way or the other, so we're just going to end the process. And so at a high level, we'll go through sort of what what are the different pieces here? How are they important? And how can you think about leveraging them? So as I mentioned, first, it starts with a great team. Unanimously, if you talk to any early stage investor, they'll say, I'm looking at team, I'm looking at what they've done in their past, what is unique. Effectively, I'm trying to answer the question of, why is this individual in this team the right one to be betting on in this specific space? Or asking the question another way, once we become convicted on a specific problem to solve, then we're doing a search and we're canvassing the market for the right team to bet on. So we're asking ourselves, can I think of any better team that might be assembled to solve this? And so your goal, as you're talking to investors, is not just about how your experience and how your training ladders up into making you the exact right founder, the exact team, but also how you're going to be able to continually recruit that team, build and retain them, and also how you might be able to steward that over time as markets may or may not get challenging. Then after that, we're looking for that $1 billion market opportunity. And we'll see a range of businesses. Some people will have enterprise customers, some won't. I always think this is a really helpful graphic here on number of customers versus price point. And so effectively, if you're looking at the size of the animals, that corresponds to the overall contract value. And the way to think about it is, if I've got a really expensive product, I can probably have a smaller universe of customers to give me that $1 billion TAM. And down here, what we're looking at is probably more in the world of consumer products. So I get that question from founders all the time. Well, some VCs invest in consumer businesses and some don't. And how do I understand the variance between those? And they're really looking to ladder up into, is the TAM big enough? And so that's how you can think about your average revenue per user versus your universe of users as you're doing some quick TAM math and modeling. And by the way, at the earliest stages, you can think about this in the same way that you would a case study interview. The exact answer almost never matters. We're looking to hear the inputs and the way that you're thinking about the question, because the earliest stages, it's all conjecture. We're telling a story of what we hope happens. And then post-investment, we're off on the journey to try to actually get there. Then the next thing is looking at the product and the technology. So we're measuring the innovation and the uniqueness. And what does that mean? There's a lot of incremental technology in the market. There's a lot of ecosystems that you can build apps in. That's great for building businesses. But when we think about big exits and swinging for the fences, we're looking at fundamentally landscape changing, seismic sort of shifting technology. And so how is this an overall improvement, launching of something that's going to be net new? And by the way, that also gives you a sense of the competitive moat around your business. The more novel the technology and the approach, the more of a moat you're probably going to have. Milestones and traction certainly matter. At the earliest stages, you're probably not going to have a ton of revenue. But I always tell founders, it's almost easier at the earliest stages because it's up to you how you're going to tell that story of traction. What does traction mean to you? And so you can look at the question another way and ask yourself, how have I contextualized to myself and to my team, how have we satisfied that the market in fact wants what we have? Is that a social following? Is it a wait list? Are those letter of intents? Are they partnerships? Think about this in the way that you would think about building a typical sales funnel. What are the leading indicators, the things that I'm tracking that let me know eventually these things are going to convert into revenue? And once you can tell that story, you realize how revenue is great, but not having it is okay once you can tell the story about how you plan to get there. And then there's certainly the business model. We can have a great founder, great technology, great product, great wedge, but maybe a suboptimal model. And the good news, by the way, is that this is very often where we'll see companies sort of pivot and learn a little bit more, maybe switch around their models a little bit. And it's ultimately finding the right way to monetize your product that accurately reflects the value that you are providing to the customer. And I think one of the great levers that we all have example to is that most of the business models that exist have been well studied, well codified. And so there's never been sort of a larger compendium of information for you to look through to say, which one might be the good fit? What should I test? And what are some common missteps that maybe other companies building my channel have fallen into, and how can I avoid those? And then we're looking at go-to-market and the competitive landscape. So how are you going to make money? How are you going to acquire customers? And how are you going to keep your customers? One of the most important things that we look at the earliest stages is not just your customer acquisition, but also your retention. A few years ago, investors realized that it was really easy for people to run Facebook ads and get customers. So retention is really important for us. Not only do people show up, do they buy, but do they return and do they continue buying? That is a great indication of value that you're providing. The other great thing about having a strong go-to-market strategy is that any investor is going to want to see this. They're going to want to see what is the machine whereby you can put in $1 or $3 into your go-to-market machine. We'll see more come out on the other end. But it also gives you a pathway to steward towards profitability. What if you're out trying to raise in a market that just is not as salient and right for investing as you thought? Knowing how you're going to go about acquiring customers, maybe your targets might be a little lower because you have less money to invest, but execute against your go-to-market at all costs. And I also think in the same vein, it's really important to talk about competitive landscape. Few things to keep in mind. There's no startup out there that does not have a competitor. And if you think that's you, you might not have a business. And at some point, all founders run into sort of 4 to 5 competitive forces. And so I always think it's really helpful as you're doing your planning, I'll wrap it up in a minute, as you're doing your planning with your teams to ask yourself which of these forces we are encountering and how do we think about hedging against those? How can we better plan against that? And then finally, you can have all of the right things happening in your business, and sometimes it just comes down to the deal. And if the deal doesn't fit for any reason, and sort of I've listed the top 3 common ones here, that also might not lead to an affirmative decision to invest. And so what are the top 3 areas that we see sort of deals going sideways? 1, unrealistic valuations. I always tell founders your valuation is like a mortgage. You want to make sure that it's something that you can grow into. No one wants to get to that next round of fundraising and realize they've got to do a down round. That makes it that much harder. The second one is founders' unwillingness to give up equity or control. That goes back to my earlier comments around really understanding what it means to take on outside investment. And also remember, at the time where you're taking on investment, you should be looking at this from the perspective of how do we make this pie larger? Because ultimately, 100% of a company worth 0 is 0. And finally, lack of a clear path to profitability. So this is where having a solid go-to-market really matters. It'll evolve over time, we all know that. But being able to tell the story of here are the different pathways of growth that we're looking at, and here's how we're going to ensure we get there, that's going to make an investor feel pretty confident about your ability to take that capital and turn it into something more. And so finally, what kind of businesses might not be a fit for VC, but I think they're incredible, they create jobs, they provide incredible community value, and so that's why I shared that list of 15 other sources of funding that all businesses should be looking at as they're thinking about how they build. So first, we've got local service businesses. So there might be go-to-market, good product market fit, but what we're missing is that path to scalability. Social enterprises with long-term goals. So again, a community-based organization, they can provide essential services, but we're going to ask ourselves about that pathway to profitability and the balance between impact and profit. Traditional manufacturing, so capitally intensive businesses. This is something that, again, remember we're looking for a 10x return. And so if it's a heavily capitally intensive business, that's going to give us a little bit of pause. But I will say recently, especially in the climate tech vertical, we have seen more of those deals happen. And then finally, single location-based businesses. And I think that goes back to the first point around if this is where you're starting, make sure that you are telling that story and that vision of scale. You could see how WeWork might have fallen in, which is a co-working space company, could have fallen into that last category. But the difference is that as they were going out to market to investors, they were telling a story about global scale. So if that's your ambition, make sure you highlight that. And most importantly, remember that how a business is funded doesn't make it more successful or not than others. The enduring things that really matter are the impacts that you're having on your community, your employees, your customers, all of the different stakeholders around your business. Never lose sight of that. That is the most important thing, the most important asset you have. Steady returns. Steady returns don't always mean a 10x return. And those are great things too. And also local growth. Local growth is really important because then you're creating a pathway to reinvest a lot of those funds into the local community. So really high-level thoughts on what it means to raise venture capital. Is venture capital right for your business? I think at any point in the market, at any point in time, at any point in your business, the answer might be yes or no. I think what I'll leave you all with is focus on building a business that has really solid fundamentals. So you have maximum optionality to consider around how you want to fund your business. And then also make sure that you're always looking at the process from the perspective of the investor. We spend a lot of time making our personal pitch and presentation perfect, but remember that your investor has goals, and the more that you can put yourself and view your business through the lens of an investor, the more likely you are to have a successful conclusion to your process of raising funding. Thank you all so much. This has been wonderful.